So, Dennis, a lot of people are out trying to find the silver bullet, want to get the get-rich-quick stuff, and oftentimes I think that can lead to people making some pretty bad mistakes with money. Do you see that?
My business, because we do financial planning in addition to investment management, we get to see the full spate of human folly over time, and there's a lot of it. And there's 4 or 5 mistakes that people consistently make, which hurt them, and a couple of them are particularly right now. People are looking for higher returns. The higher the return you get on your investment, the sooner you reach your goals, and the sooner you can retire or buy your boat or whatever you're going to do. Well, today we're in an environment where interest rates and returns are pretty low. Cash yields about 1 basis point. That's 1/100th of a percent. 3-month Treasury bills are a 1/4%, so on and so forth. And if you go all the way out to a 30-year, you can get a whopping 3.25%. But you got to expose your money for 30 years of risk. Well, people are running around trying to figure out how to get higher yields. And so what that does is that makes them vulnerable to the get-rich-quick, it's too good to be true, scams, and they start to take risk. Now, you got to understand that what's going on right now with the Federal Reserve and the other central banks is they're trying to get people to take more risk. They need this money to move around, and they want people to take on risk assets. If you fall for it, you will eventually get caught when the demand for risk assets lessens or interest rates go up or whatever. So you have to be careful about what you're reaching for. The higher return you're reaching for is going to come with higher risk. That's one of the immutable laws of investment. Higher return always comes with higher risk. Mm-hmm. So be careful about what you reach for. Be careful about how you do it. If it sounds too good to be true, it is. And if it's really, really good, if it sounds really, really good, understand that the guy who's selling it to you or the woman who's selling it to you is going to make a lot of money off what you're going to give them.
Now, there's that element of optimism, I think, that goes into these get-rich-quick things, isn't there? I mean, people just imagine that, well, gosh, it must work.
Well, there is a unique personality trait that I think is American, and that is this idea that we just need one thing to make us rich. One stock, one real estate investment, one something. It doesn't happen that way. If you go through the Forbes list of billionaires, you'll find that most of them got wealthy quite slowly, and most of them are even older than I am. I know it's hard to believe, but there are people older than me. And they worked really hard to get the money over time. But we still have this idea that we need to get in on something, whether it's silver or gold or real estate or whatever, and we're just going to make one big hit, and we're going to make it. And all we hear about are the people who make that one big hit, or look like they make that one big hit. I, years ago, met a singer by the name of Jim Croce. He's now dead. Bad Leroy Brown, those kinds of things. And he seemed like an overnight success. And I said to him, I said, it's amazing how fast you got popular. He says, it's almost overnight. And he says, yeah, he said, except for the 10 years of singing in bowling alleys. Mm-hmm. And that's what happens. We don't ever hear about the struggles. We hear only about the successes. So that's what people do. They reach for things, and they get caught. So, the second mistake that people make, and this is very controversial these days, what's the fastest growing expense in the United States?
I believe it's like kids' college.
College expenses. 7% inflation per year is tripling every 3 years. If you have a 2-year-old today, in 16 years to put that kid in Stanford is going to cost you $500,000 for 4 years. Now, that's unsustainable. So people are bankrupting themselves. People are borrowing from their retirements. People are they're doing everything they can so that their kid can get into some, prestige college. What's also interesting is that the value of those educations is going down. In other words, all the money you spend and the salary increase that they get from going to Harvard versus going to the University of Washington is narrowing down. So there's no reason to spend $50,000, $60,000 for a good college education unless you got some really, really bright kid. And of course, this is like Lake Wobegon. All the kids are above average. It's better to send them to a state school for their undergraduate and then send them to a really prestigious school for the graduate work.
And I believe that the value comes down, especially because so many jobs are so hyper specialized. You don't go to undergrad. You go to undergrad and you come out with what? You had some English classes,
Right.
you had some math classes, right? And then
Right.
at the last year or two, you take some, higher level classes in that are still pretty generic.
They're very generic, and it's a liberal arts education. And you're right; it doesn't specialize you for many jobs. But some of the best colleges in the world do not give specialized degrees undergraduate. They only give BAs in liberal arts, but they prepare you in a way that allows you to go to graduate school and get a higher degree in some specialization.
And that's where you can then, for lack of a better term, make the big bucks
That's
out
where
of
you make the big
college
bucks.
because now you are, one of maybe
those.
1,000 or 1,000,000 people rather than just another college graduate.
Exactly right. And you know what the most common grade given in college these days is?
A pass. No?
An A.
Really?
It's not a C anymore. It's an A. So undergraduate school does not mean as much as it used to mean. And a lot of 54% of last year's college graduates are still unemployed. Now, when you have a degree in socioeconomics of primitive societies, I can understand that. There's very few professions for that. I mean, you end up being a garbage collector in Tukwila, but which is about as low as you can go, folks. Anyway, onward. I knew I had to get that in there. Ben's been preparing for that all day.
Always.
All right. So the third big mistake that people make is they own stock in their employer. And this is particularly true at places like Apple and Microsoft. You got these big stocks that have done well for people, and you accumulate them because you think they're the best thing to do. If you over-concentrate your portfolio on one stock, you will consistently underperform, not the stock market, you will underperform inflation because that stock's volatility will kill everything else you're doing. The second thing is people put the stock in their retirement accounts, and at the same time, they're owning mutual funds that own the same stock. That's just doubling down on the same risk. You should never own your employer stock in your retirement account. That's a diversification. Do something else. And you look at what happened at Enron. Most of those people at Enron, they had 40, 50, 60% of their retirement in Enron stock. My old employer, Bear Stearns, there were hundreds of people at Bear Stearns who, when they left the firm, when the firm went under, they lost everything because they were forced to have Bear Stearns in their retirement accounts. And when Bear Stearns stock got sold out, they lost all their money. Mm-hmm. So you want the retirement account is something that should transcend your employment. And it shouldn't be keyed to the company stock.
Well, and I would think that, some people who are into a company early, maybe, with that idea of hitting it big at a company, it certainly is a little bit different than working at maybe a Microsoft where, sorry everybody, but Microsoft hit it big a long time ago, and you're probably not going to see those splits and those returns that you did in the early 90s.
That's exactly right. And I mean, Microsoft is a good company. It's got great dynamics and returns, but it's not what it was in the 1980s and the 1990s, and never will be again. It can't be too big.
Right.
So owning the stock, in your portfolio, while in your 401k plan of the mutual funds they use, every one of them, a top 10 position in one of the top 10 positions is Microsoft. Plus, you're getting grants and you're getting awards of stock, so you're always getting more stock. So why double it up in your pension plan? Mm-hmm. That's silly.
Yeah. What are some of those last couple of tips that people you see?
Well, one is very interesting. That's Social Security. A lot of people can't wait till they get to be 62. They can take Social Security. If you wait from 62 to 66, the amount of money per month you get doubles. And if you wait till 72, it's even better. So one of the mistakes people make is they take Social Security too early, while they're still working or while they still have income coming from retirement accounts, which is taxable. Because Social Security is means tested. It's taxed. The more income you make, the less of Social Security gets excluded from taxes. So you don't want to take Social Security early because you're giving away that money, because you don't get it. Once you start taking it, all you get is an inflation adjustment. You don't get the benefit increase that you get between 62 and 66. So you don't want to give that away. So that's one of the big mistakes that people make. The final mistake that people are making, and they're making it right now, is people are looking for yield. They're buying bonds with long maturities. Now, if you have a bond, let's say it's yielding 3%, and it's 30 years to maturity, and interest rates go up a point, that bond will go down 18% in value. I'm not sure I want to risk my money at 18% to get 3. Mm-hmm. That seems silly to me. Mm-hmm. And so people make this mistake all the time of going out looking for these long-term bonds, and all they see, again, the focus is they see that return that they're getting that's so much better than what they're getting in cash, and they get drawn into this thing. And that's exactly what people want you to have happen is they want you to buy these bonds, and you need to avoid being dragged into a mistake that can hurt you badly.
Dennis, we have about a minute left, but do you have people come to you that want the silver bullet? I mean, they want the big hit, and and that must be it's tough to balance that with the obvious desire for getting rich quickly and the reality of the world we live in.
We have people who come in. They usually don't stay very long because we tell them we can't do that. We're short on silver bullets. We're neither the Lone Ranger nor are we going out to try and kill werewolves. But what we try and do is we stress the idea that put the money to work, find the return that you need to make on a compounded basis that will get you to your goal. And don't worry about whether you're beating the S&P because you don't necessarily want the risk of the S&P. What's interesting about people who reach for big yields is that they want the return, but they don't want the risk that's associated with it, either volatility or principal risk. And they just cannot get through their heads that one goes with the other. And you don't need, if you give it time, you don't need that much return to make your goals.
Mm-hmm. Mm-hmm.